Good morning and welcome to our business relief seminar. And this morning I'm joined by my colleagues Edward Marriage and Jonathan McDowall. We're going to cover what is business relief, how business relief works, the problems, how to solve them, investing in assets that qualify for business relief, and then we'll end up with a live question and answer session. If you have any questions, pop them into the question and answer box at the bottom there. And before I pass over to my colleague Edward to get us started this morning, I will also just say that for those of us that have been dealing with business relief for many years, it has been called business property relief previously, BPR, now business relief, BR, although if we do use those slightly interchangeably, do forgive us. I'll pass over to my colleague Edward now to get us started this morning.
Thanks, Lucy. Good morning, everyone, and welcome to our introduction to business relief. So today I'm going to be doing a brief introduction to business relief, what it is, how it works, what qualifies for the relief. I'll also be touching on various aspects of the relief, such as the qualifying period and accepted assets. So firstly, what is business relief? Well, business relief is a very useful relief which applies to inheritance tax. So inheritance tax is usually charged at 40% and usually applies on death, and it applies to the death estate. It can, however, also be charged during a lifetime when assets are placed into trust. So depending on the asset in question, the relief will either be at 50% or 100% of the total value of the asset. Various conditions must be satisfied, and the relief will only apply to relevant business property. So it's important to realize that business relief is only a relief in that qualifying assets are not removed from your estate. So where you make a potentially exempt transfer or a PET, and the assets are taken from the estate after 7 years, assets qualifying for business relief remain under your control, and you will receive the relief on death. So for those of you who caught our last webinar on family investment companies, you would have seen how PETs could be used to reduce the estate below 2 million, and this was to capitalize on the full residential nil rate band. So business relief can't be used in this way, as the assets will remain taxable just at a lower rate, which is usually 0%. So now I'll briefly touch on what qualifies for business relief. So there are 5 main categories which would qualify for this relief. The first is a trading business. So this can range from a small sole trader business to a share of a large partnership. Secondly, there are shares in an unquoted trading company. So this would usually consist of a majority of owner-managed businesses that don't derive their income from investment activities. Thirdly, is property that's used in a trading business. Next, shares in a qualifying trading company. And finally, there is forestry. And this is an area that Lucy is going to cover in more detail in a bit. So as mentioned at the start, there are different rates of relief for business relief. So to achieve the full 100% relief, sole trader businesses and partnership shares get the full 100%. Also receiving the full relief are unquoted shares in a trading business. So this is your owner managed businesses. It is also important to note that this includes shares that are listed on the alternative investment market or the AIM market. And Jonathan will be looking at this in more detail. So 50% relief is given where the taxpayer has voting control of a quoted trading company. So this is a much more unlikely scenario, as most quoted trading companies are very large and the ownership is usually spread across thousands of shareholders, BT, for example. So finally, you'll see in the final box in the bottom right, 50% relief is also given to property or assets that are used in a trading business. So this is usually the case where a sole trader or a partner owns office space or vehicles that are used for the trade, but they own them personally. So where that's the case, these assets can receive relief at 50% of their total value. So to obtain business relief, the property must have been owned by the transferor for 2 years immediately before the transfer, or it must have replaced other property which was owned for 2 out of the 5 years immediately before the transfer. If the transferor became entitled to any property on the death of another person, they are deemed to have owned it from the date of that death. However, if the deceased was their spouse or civil partner, then they're deemed to have owned it for any periods that the spouse or civil partner owned it. So to obtain business relief, a business must satisfy the wholly or mainly test. So in the context of business relief, this means that a business must have at least 50% trading activity. HMRC has set out various businesses that will not qualify for the relief. These are businesses that deal in shares and securities, businesses that trade in land and buildings, investment companies such as rental portfolios. However, it should be noted that there is scope for some furnished holiday let businesses to qualify, but Lucy will cover this in more detail. And lastly, businesses that are trading without a view to make a profit, hobby businesses. Perhaps someone started a cake baking business using expensive ingredients and decorations and selling it to their friends at costs, not for profit, but just for the enjoyment. This would not qualify. So the wholly or mainly test used to determine the trading status of a company, this encompasses a variety of different factors. So not one aspect of the company is looked at and the company is considered in the round. The first test will be the capital employed. So this is the value of the capital allocated to the trading arm of the business and the capital used for the investment activities. The second test is time. So where do staff spend most of their time? If a majority of company time is spent looking after the investments, then it's likely that it is not wholly and mainly a trading business. The turnover of the company is also an indicator of the nature of business. So where a business derives most of its income from its investments as opposed to the trading activity, HMRC will see this as an investment business, similar to the profit. So as you can see, it's really important to look at all 5 factors, and if it is shown as 50% trading, then business relief will apply. However, where a business qualifies for business relief, it may have what's called accepted assets. So an accepted asset is an asset which is not used wholly or mainly for business purposes in the prior 2 years and is not required for the future of the business. So as an example, if a business is accumulating large amounts of cash, which is not needed for the running of the business, HMRC have taken the view that this cash is an accepted asset. If, however, the business can prove that the cash is earmarked for future trading activity, for example, the purchase of a new factory, then it can be made exempt and will not be treated as an accepted asset. So here we have an example of how accepted assets work. So in this example, X owns all 100 shares in X Limited, and this is all relevant business property, so it gets the 100% relief. X Limited owns assets worth £100,000, 20,000 of which are accepted assets. So X decides to give 25 shares to its son, and they're valued at £25,000. So of that 25,000, 80% is attributable to the relevant business property, the trading portion, and 20% are accepted assets. So business relief is given on 80% of the 25,000 being 20,000. So that was just a very brief look at business relief. I'm now going to hand over to Lucy, who is going to go into a bit more detail. Thank you.
Thanks, Edward. And I will just start sharing my screen, and what we'll cover over the next few minutes will be the types of business that business relief can apply to. And what we'll do is we'll go through some of the issues that these types of businesses would come across with business relief, some possible solutions, what records you need to keep to make sure you've got the strongest possible business relief case. And we'll finish off with some possible future changes to the relief, especially given that we're coming up to a budget in October. Let's start with sole traders and partnerships. Generally speaking, these can be the most simple entities for trading through. If we're looking at a simple sole tradership or a partnership that's a fully trading business, we're looking at business relief will apply. And the most common things that we would have an issue with here are associated assets and accepted assets. When looking at whether the business does apply for business relief as a whole, just to start with, we'll just look at how that gets determined. Ed's given us a very good background to that, the 5 factors, but a lot of it's been determined by case law, so it's really important to look at that. When looking at the actual problems with these businesses and these associated and accepted assets, the associated assets, again, it's something that Edward touched on. This is where you've got assets that are used in the trade, but perhaps aren't actually held within the trade. They're partnership assets not held on the balance sheet, owned by the partners individually. In this situation, they would get the relief at 50% rather than 100%. And very often those assets could be brought into the partnership and therefore get the full 100% relief. I will caution that to say it's important to take advice around that. There are other legal and tax issues that need to be looked at to see whether that's the right solution for a business. And then accepted assets. Again, Edward's given us a background as to how that works, the types of accepted assets. The one we see most commonly is cash, an excess of cash, a good profitable business, and they've not been withdrawing all the cash every year, so it's built up within the business. The most common solution there is that it's been a very profitable business. You're then looking to expand. If there is an actual plan set out for that cash, perhaps expanding, buying a new property to trade from, buying a new site, any of these things, that would then be seen as a genuine use for that cash in the future of the business, and it would not be an accepted asset. So we'll move on to where it gets a little bit more complicated. Farms and landed estates. As most of you know, farms and landed estates have been diversifying over the last few years. Diversification has been massive in this sector, and it means that where you perhaps had a fully farming business and that everything was trading, it was all very cut and dried, that's not the case anymore. I mentioned on the last slide case law. 2 of the most important cases that have come up with business relief have been the Balfour case and the Farmer case. Both relate to farms and landed estates. And they've shown that when you look at the business in the round, as Edward went through, it's what the business looks like as a whole that matters for whether business relief applies. Where we get quite a good example of this with farms and landed estates is you've got the farm, that's the trade, everything there is trading, but you've perhaps also got the cottages that where they used to be let to farm workers are no longer needed for farm workers, less farm workers on the estate, and they're now let to unconnected individuals. So those let properties, if you were looking at them in isolation, would be non-qualifying assets. When looked at in the round, as long as they are not too significant a portion, and that it's that 50% test that we've talked about, then the business should still qualify as a whole. But it's really important to look at, because when you're looking at those 5 factors, the property is perhaps more profitable than the farm, and in bad years for the farm, the majority of the value on the balance sheet is perhaps the farmland. So that's very much sitting in the trading column. So there's a lot to look at there. And before I move on, the last point I've got on this slide is agricultural relief. Now, we're very much focusing on business relief today, but just to say that agricultural relief normally applies before business relief, but it only applies to the agricultural value of the land. And very often that land can be worth more. Perhaps there's potential development value, there's a number of reasons why that land could be worth more. And if business relief applies, it will apply to the full value of the land. So it can be really important to make sure that the business relief applies as well as the agricultural relief. And honestly, this is a sector, we could probably do a whole webinar just on this. But given that we're trying to cover all of the assets for business relief today, we'll move on. Staying with partnerships for a moment and looking at another complication. Sorry, we've got partnerships that are holding, unquote, a partnership holding shares in trading companies, unquoted shares. So here we've got a partnership, it's the individuals, 4 partners holding the partnership, and then we've got 3 trading companies underneath that. When looking at a partnership, it's the business of the partnership that is looked at, not the underlying assets. So although these are 3 trading companies, the business of the partnership is purely in holding the shares in these companies, therefore it's holding investment assets. Therefore, no business relief would apply. This isn't the case with a company. If a company is holding trading companies, then business relief very often can apply. So in this situation, a possible solution here would be to look at incorporating that partnership into a company, and then business relief is potentially available again. Now, I will qualify that to say, well, you can incorporate. Again, you really must take advice. There's capital gains tax and other taxes that you'd want to carefully look at before going ahead and incorporating. So that's some of the complications around partnerships and sole trades with business relief. And we'll now come on to incorporated businesses. Again, with incorporated businesses, if we look at just a simple business, your sort of average family-owned business or small company, it's the overall trading position. We've probably not got too many issues if it's a trading business rather than an investment business. And it's also important to note here that it is the shares in the company that are owned by the individual that are exposed for inheritance tax, and therefore that the business relief would apply to. So while you look at the overall business to determine whether the shares qualify, it is the value of the shares that we would be looking at for business relief. However, again, we've got to look at assets used in the business. If we've got assets held personally that are used in the business, they're only at that 50% rate rather than perhaps the 100%. So again, looking at whether those should be brought into the business. And looking at the business as a whole, are there accepted assets sitting on that balance sheet that you might want to look at doing something with, or making sure there's a plan and a justification as to why they're not an accepted asset. Where we start to have more fun with companies is when you get into group structures. So you've got a group of companies, and here you need to look at the group as a whole. We've already touched on holding companies. And so we perhaps have the holding company, you need to look at the subsidiaries, you need to look at where the cash is held within the group, where assets are held, whether there's perhaps any partnerships or offshore companies within that structure. So an awful lot to look at there. We'll look briefly at an example. So here we've got a holding company and we've got 3 subsidiaries. Subsidiary 1, trading activity, 70%, it's qualifying for business relief. We'll jump quickly to subsidiary 3, it's holding a property which is leased to subsidiary 1. Property used in a trading business, it's going to qualify as well. In the middle here, we've got subsidiary 2, and it is also holding property, but property that is not used in any part of the business. It's just let properties. As a let property, this is not going to qualify. And therefore the value of that group, of that subsidiary from the group as a whole would be excluded from business relief. So just to put an example on that, let's say that the entire group is worth £10 million. Subsidiary 2 is worth 3 million. When you're looking at the business relief available on the shares in the holding company, because that's where it would apply, you would restrict that relief to 70% of the value of those shares in the holding company. There's an awful lot of things that can be done. You could look at removing subsidiary 2 from the group, perhaps looking at other ways to protect that for inheritance tax. Perhaps it's being used in future retirement planning. There's an awful lot that can be done. What we would say here is that it's really important before you restructure or do anything here that you take advice early, especially if you're looking to sell a business or anything. There's clearance procedures that can be done. There's other reliefs available around the restructuring, but a lot of these do take time to get in place. So it's really important to take advice early. And a bit like the farms and landed estates, we could do a whole webinar on this, but we did promise to keep to time this morning. So I will move on, but if you've got any questions around this, then do get in touch. We'll move on to let properties and furnished holiday lets, an area that I find very interesting just because of the contrast in the tax treatment. Normal let property, it's an investment asset, no business relief. That bit's fairly simple. Where it gets interesting is around the furnished holiday lets. And again, it's case law that has really been driving this in recent years. If you've got a furnished holiday let for capital gains tax, income tax, that would be seen as a business. But for inheritance tax and business relief in particular, it very often is not. If your business, you're doing the changeover every week, perhaps putting in a small welcome basket, and that is the extent of the business, it would not be seen as being sufficient to get business relief. Where cases have managed to get business relief, it's been where there's been a lot of additional activity around the furnished holiday lets, perhaps walking tours, meals provided, foraging tours, bikes available for hire, all sorts of additional activities. We'll come on in a moment to the types of documents that are needed to make sure your claim for business relief is as strong as possible. Around furnished holiday lets, this is particularly important if you're wanting to be able to demonstrate the level of activity that's been going on, especially if the person who has been doing all of that activity is the person who's died at the time that you're needing to actually look at that business relief. So we'll come back onto that in a moment. First, another very popular area at the moment is forestry. Forestry, commercial forestry, qualifies for business relief. It qualifies for a number of other tax reliefs as well, capital gains tax, income tax. We won't go into that today. We're very much concentrating on inheritance tax and business relief. But just to say, because of all of those tax reliefs, and most commonly, the one that is very often the biggest driver is the business relief for inheritance tax, it's making forestry a very popular investment. And forestry prices are about as high as they've ever been at the moment. So a very interesting area to keep an eye on. So when should you review your business relief position? This is really the important bit. You've got your asset. Now, how strong is your business relief case? Ideally, you should review the position before any known IHT event. If it's a known event, it's very often going to be a lifetime event, such as a chargeable transfer when you're putting assets into a trust, perhaps a potential restructure or sale of a business when looking at the business succession, but also if you've got a family member and there are concerns over health, you think that the business relief position is going to be subject to scrutiny. I will also qualify with that to say that when those events are occurring, there's an awful lot that needs to be looked at, and they can be quite stressful times. So I would encourage you to look at the business relief position regularly between these events. Make sure that you're aware of what business relief you are eligible for, and that you've got the paperwork in place to actually back that up at the time that you need it. So that brings us on to what records do you need to keep? What evidence is there to support your business relief claim? The most obvious ones are the accounts and tax returns, and they'll be there. They're held by your accountant, by your tax advisor. But there's a lot of other documentation that can be important. We talked about it with the furnished holiday lets, evidence that you've gone above and beyond, that you've done all of those extra activities. Some of this could be emails between family members to talk about the additional services that are being provided, records of those additional services that have been provided. Equally, there can be many aspects that HMRC will look at in reaching a decision, so do keep records. The last thing we want to just cover before we go on to some of the speculation on changes is clearance. So if we've got an IHT chargeable event coming up, you can request prior clearance from HMRC to see if business relief would be accepted. Now, it's important to note here that they will not consider it on hypothetical cases or where there's no IHT liability in charge. It's only on a chargeable IHT event. So perhaps you've got a business worth a couple of million and you want to put it into trust for the children or for the grandchildren, £2 million. If HMRC denied the business relief claim on that, you would have a very sizable IHT charge on that lifetime event. You can write to HMRC, your accountant can do this prior clearance to HMRC to tell them about the proposed transaction and see whether the business relief would be accepted. It's only relevant at that point in time. Having said that, it is a good indication of what future transactions might be looked at and what questions HMRC might ask. So finishing off, we've talked about business relief as it is just now, but as we all know, we're coming up for a budget on the 27th of October. There is a lot of speculation that there are going to be tax increases, and could any of these apply to business relief? Some of the speculation's been around that wholly or mainly test, as we've talked about today. At the moment, it's 50-50. If you're more than 50% trading, business relief should apply. For other taxes, including capital gains tax, that's an 80-20 test. So it'd be very interesting to see whether HMRC, whether the government might announce a change to bring the business relief test more in line with other taxes. Could they make the conditions more stringent? Very possible. Could they look at furnished holiday lets? It's very much based on case law at the moment. Again, like the wholly or mainly test is differing from those other taxes. Might they actually bring something into the legislation to bring that more in line? Another one that I find quite interesting and would have a massive effect on a lot of businesses would be a potential cap on the relief. At the moment, the relief is uncapped. It's on any value. As long as the asset qualifies, then you can get up to 100% relief on the full value. And perhaps they might provide more detail on qualifying activities. So very interesting to keep an eye on that and see where that goes. But for now, I will pass you over to Jonathan to talk about the types of investments.
Okay, thanks for that, Lucy. So good morning, everyone. I'll just bring up my slides as well in and we can make a start. So I'm Jonathan McDowall and I'm one of the financial planners with Henderson Loggie Financial Planning. And so just to follow on from Edward and Lucy's comments already, I'd now like to discuss the investments that can be used to qualify for business relief and help reduce an IHT liability. My slides. So I'm going to cover 3 different types of investment that we can consider: IHT reduction plans, AIM portfolios and EIS investments. I'll explain a bit more about each investment, what they do, and their pros and cons as part of an IHT plan. So why might we use an investment that qualifies for business relief, and what are the benefits? Well, firstly, they can be used as a standalone plan to reduce an IHT liability, or quite commonly, we might use these investments along with other forms of IHT planning solutions to provide an overall effective plan to reduce an IHT bill. Now, I've highlighted 5 key benefits on screen of using business relief investments, and most of this will relate to what Edward and Lucy have already discussed today. But just to reinforce some of the key points, number 1 is the speed in which these investments can help to reduce an IHT liability. So once they're held for 2 years and at the date of death, they're then exempt from IHT. And in comparison to other IHT planning methods, such as gifting or placing money in trust, you generally have to wait for 7 years for those monies to be removed from your estate. So that shorter timescale is a real advantage. Could be more of an advantage, say, for elderly individuals or someone in poor health, where that 7-year period may just be too long. And many of these investments can also be arranged under a power of attorney as well. And that could be an advantage to someone, again, who might have left IHT planning a bit too late in life. Now, with these investments, you retain full control over the investment. And so they're like any other investment in that respect, allowing you to access your money if needed. And in some cases, an income can be produced. The exception to this are EIS investments, which I'll explain in just a moment. Now, like any other investment, these business relief investments also aim to provide you with a return, and one that can outperform interest rates and inflation. The added benefit, however, is those potential IHT savings, and that's the real advantage. Now, they're not niche or new investments. They've been around for many years, and they have proven track records of success in providing returns, as well as achieving their aim of IHT reduction. There's a wide range of investments out there and providers that we can consider in this area, and that just allows a suitable investment to be arranged for individual needs. Now, a significant benefit of these investments is that they can be passed on to your spouse or other beneficiary in the event of death. And that's going to allow the beneficiary to inherit the investment and to allow that money to continue to grow in a beneficial environment. And as an example, if a spouse inherits the investment, that 2-year clock doesn't need to restart if that period hadn't yet been reached. Or if it was beyond 2 years at the point of inheriting, well, that investment is going to maintain its business relief qualifying status for that receiving spouse. Although any other beneficiary would have to wait the 2 years to qualify and be free from IHT for themselves, it could still be beneficial that these investments pass down. For example, say there's a lot of family wealth and it's passing down the generations, where potentially maybe IHT liabilities might be present for children and grandchildren in the future. And related to that, some of these business relief investments could also be placed in trust. And finally, one area that is an advantage of these investments is in the event of selling a business. And again, relates back to some of the comments we've already had today. So if you sell a business, which was previously a qualifying asset for business relief, you can reinvest those sale proceeds from the business into a business relief qualifying investment. And that will allow you to retain that qualifying status, being then free from IHT and without having to wait another 2 years to qualify. Now, that's as long as you reinvested within 3 years of selling the business. Now, it could be beneficial, for example, if you've just sold a business, but you're not yet in a position you want to gift large sums of money for inheritance tax planning, as an example. So the first investment I'd like to cover are what I'd call specific IHT reduction plans. And these plans are offered by a range of investment managers in the market, and they'll work by investing in one or more trading companies in order to qualify for business relief. The aim of these plans is to provide capital preservation, as their main focus is on IHT reduction. And they're going to aim to do that by holding tangible assets that aim to provide stable and predictable returns on the investment. Now, whilst they aim to preserve capital, it's important to note that these investments aren't guaranteed. Fluctuations in value, potentially capital loss could occur as well. So they are deemed as higher risk. And with regard to returns, they would aim to provide a return of between 3 to 4% per annum after charges. So not there to shoot the lights out in terms of returns, but just provide a consistent level of performance. Now, the final point of highlight there on the slide is relevant if you own a company and relates to the earlier comments on accepted assets that Edward was talking about. Now, whilst many companies are likely to meet the qualification criteria and qualify in full for business relief, if the company was holding a large amount of excess cash, for example, that wasn't held for a future business use, it could be treated as an accepted asset and then excluded from business relief. So a solution is that the company could invest some of or all of that excess cash in an IST reduction plan, and it would allow that money to then be able to qualify for business relief while still being an effective investment for the money as well. Now, that's an area that's going to need some real detailed advice from your accountant and the company's tax advisor, again, as Edward and Lucy have mentioned already today. So to bring to life these IST reduction plans, this slide is illustrating an example of the areas that we typically might see invested within these plans. And I guess what we do see is there's a range of different activities, and that's going to help to diversify and reduce risk. The common theme is ownership of physical assets that can be sold if needed, and ones that can provide us with more predictable and consistent returns. Now, one benefit of these assets is they're generally not correlated to stock market related investments. And so that could be a good form of diversification if you already hold other investments, for example. And even throughout last year's stock market volatility, these investments in general continued to perform as expected and weren't affected by the large stock market falls that we experienced. And final point you'll note there is that a lot of these plans will involve investment in renewable energy. And I guess a really relevant topic to today. We've heard the news over the past couple of days, and essentially being able to provide solutions to long-term energy needs and also helping to address some climate change issues. So for many people, that might fit very well with their values and preferences for having a sustainable investment. The second investment I'd like to introduce are AIM portfolios. So the alternative investment market was created to allow smaller companies that were seeking capital to grow, but they couldn't afford to list on the main London Stock Exchange. So AIM was launched in 1995, so less limitations and costs that come with a full stock exchange listing. Now, AIM companies, they're a huge contributor to the UK economy, and the AIM market plays a key role in that in supporting the growth of these smaller and medium-sized businesses. And it allows them to raise finance in the form of issuing shares, whilst offering us as investors the opportunity to share in that growth. And since AIM started, it's progressed significantly. The types of companies within AIM have also evolved over time. There's now around 850 companies on AIM, for example. And it's a very diverse market across many different sectors: technology, healthcare, financial and energy companies, to name a few. And it's not just for startups and smaller companies. There's some really large household names. Some you may recognise: ASOS, the online fashion retailer; Fever Tree Drinks, who make those nice tonics to go in our gin. Now, they've delivered significant returns to investors over the years. And also, there's some really long-standing businesses. Some have been around for over 100 years. So it's not just new, smaller companies. It's maybe a bit of a misconception with AIM. Now, the importance of AIM for us today is that AIM shares are classed as unquoted, and provided they meet criteria, can qualify for business relief for inheritance tax planning. Now, as Edward mentioned earlier, there are some specific industries and activities that will be excluded from qualifying for business relief, and there are companies on AIM that then won't qualify for business relief and wouldn't be effective for IST planning. So really important that the right companies are selected from both an investment perspective and an IST perspective. So how might we access the AIM market for IST planning? Well, you could go out there and select your own AIM shares if you felt confident and had the experience and knowledge to do so. But for me, it's a task that's best left to the professional investment manager that specialises in this area. Now, thankfully, there's many of those out there, and they've been running AIM portfolios successfully for many years for the purposes of IST planning. An AIM portfolio manager is going to create a portfolio of selected AIM companies, generally about 20 to 40 different companies they'll put in the portfolio. And their objective being to select those quality companies that can increase the value of our investment, but also managing any unnecessary risk towards the portfolio. So they're less likely to invest in those smaller, less developed companies on AIM. And the focus will be more on the medium to larger size companies that have got the strong balance sheets and potentially more stable revenues and profit. So the AIM portfolio manager is going to carry out a detailed analysis in order to select those appropriate companies, and they're going to review that on an ongoing basis and make changes or additions where necessary. And importantly, for the business relief qualification aspect, most AIM managers are going to use the services of a third-party tax advisor. And they're going to review the portfolio holdings to ensure that they continue to qualify for business relief. Otherwise, the share is going to be removed from the portfolio as it wouldn't then be fit for purpose. In terms of performance, well, investing in well-established AIM-listed companies has delivered significant outperformance against, say, the main UK stock market indices and other international stock market indices as well. So it does offer a really attractive investment opportunity. As an example, there's some AIM portfolios out there that have doubled their investment over the last 5 years, so some really strong performances. But it is very important to bear in mind that AIM shares will tend to be more volatile than your blue chip company shares on the FTSE 100, for example. So you need to be aware that AIM shares can carry greater risk. There's greater potential their value can fluctuate, potentially more widely, and greater losses could occur. And that's down to that smaller nature and the nature of the AIM market as well. And related to that, AIM shares could be less liquid and harder to sell than, say, your FTSE 100 or FTSE 250 companies. But finally, an added benefit of AIM shares is that they can be held within an ISA. And that allows you to shelter your money from income and capital gains tax, but with added benefit of potential IHT reduction as well. So potentially really good benefit of these investments. Now, the last investment for me to talk about is EIS, our Enterprise Investment Scheme. So it's a long-standing government initiative aimed at encouraging investment in small and medium-sized companies. Traditionally, we'd use EIS more for the income tax and capital gains tax reliefs that we can obtain, but they could also be used as a form of investment for IHT planning as well. Now, EIS is generally designed to provide capital and finance to those smaller companies to help them progress and move on to the next stage of their development. And as with other investments I've mentioned today, EIS investments are widely available. There's many investment managers specialising in this area. So within that, they could be arranged in multiple companies or just in one company alone. And once again, there's a diverse range of companies and market sectors that may be invested in as well. Now, the majority of EIS, though, is going to be in your early stage companies that have the potential to grow and be successful. And whilst there are many successful businesses that have taken advantage of EIS investment and they've grown to be large businesses, there's also many cases of complete failure where the company hasn't reached its potential, and that's resulted in complete loss to the investor. So this high-risk nature needs to be considered. And due to that high-risk nature, I'd recommend that you take professional advice before considering EIS and also using an investment manager that is experienced and has success in EIS investing. Now, in return for taking the higher risks of an EIS, the government does give us fairly generous tax benefits. And as my slide summarises here, there's 5 key tax benefits associated with EIS. Now, for the purpose of today, EIS shares are unquoted and can then qualify for business relief. So that can be an effective part of IHT planning. But in addition to that benefit, there's also further tax benefits in the form of income tax relief at 30% of the investment made up to certain limits. Any gains made on the sale of an EIS are free from capital gains tax. You can defer previous capital gains into an EIS, and that can allow you to defer a gain in the tax due to a future point if that were to be beneficial. Now, a very important point is to retain these benefits and the tax reliefs that EIS provide. We must hold the shares for at least 3 years. But in reality, an EIS investment, because of its high risk nature, should be considered a long-term investment, and realistically will be held for a lot longer than 3 years because of that. And related to that, due to these higher risks, an EIS can utilise loss relief if it was needed, whereby a loss can be used to offset any income or capital gains tax bill. So softens the blow to an extent if a loss were to occur. In general terms, for a client focusing on IHT planning, an EIS might not be our first solution, but where there's a need for taking advantage of these multiple tax benefits, they could be used as an effective solution. So whilst I've highlighted a lot of benefits of business relief investments for IHT planning, it is very important to be aware that these benefits don't come without risk. So they'd all be deemed as high risk in their nature of investing in unquoted and in many cases smaller companies. So that can mean your investment could be less liquid and harder to sell. Also means there's no guarantees over the returns you may receive or the capital that you've invested. So we need to be aware of fluctuations in the value of the investment as well as losses could occur. So they won't be suitable for everyone. And that just emphasises the need for professional advice in this area to assess whether they would be appropriate for individual needs, circumstances and financial position. So hopefully that's been a helpful summary of investments that can qualify for business relief. Overall, they can be a very effective part of IHT planning. It's important to consider the risks alongside the benefits, and for that reason, the need for professional advice before considering these is very important. So at Henderson Loggie Financial Planning, we're experienced in advising clients on IHT and using business relief investments, and alongside the expertise of Henderson Loggie Chapter accountants, we can advise on an effective plan to help reduce a client's IHT liability. So if it's something you'd like further information on what we've discussed today, please get in touch. We'd be happy to discuss. But I'd now like to hand you back to Lucy for any questions that have been raised today.
Thanks, Jonathan. So we've had a few questions so far. So I'll start off with one for Edward. What level of cash would be needed in the business for it to be seen as an accepted asset?
Yeah, it's a good question. It's one we often get asked to look at with clients. So generally over 20% of the value of the balance sheet is seen as the danger area, although there is no specifics in the legislation. So unless, of course, you have a plan for the cash within the business. So if you do have a high cash balance, then it is definitely worth taking advice and looking at in more detail.
Thank you. One for, I think one that actually came in for me. Do you think the Chancellor will reduce the relief at any point as he seeks to recoup the COVID support? Hopefully from that slide on the speculation, yes, I think it's possible. I think the budget will be very interesting on the 27th of October. We'll be keeping a close eye on it. We'll have stuff out as soon as we've heard what's happening in the budget. I think the two areas I would be most keen to have a look at there and think about is whether they might change that whole yearly test from the 50-50 to 80-20, and whether they would put a cap on it. I think those would be the two things that could have the greatest impact on the types of businesses that we work with. So hopefully that's answered your question. But even if you do want any more information, let us know. A question that came in for Jonathan. You mentioned placing the IHT reduction plans that you discussed into trust. What would be the benefit of that?
Yeah, so one potential benefit might be in case we see if someone said an estate worth over £2 million, and there might be an issue where they may no longer qualify for the main residence nil rate band. And so in that case, by placing these investments after being held for 2 years into trust, would provide a means to help reduce the value of their estate and possibly help to reclaim that residence nil rate band. So that's a type of scenario that could be used as well as alongside just passing assets down the generation, as I mentioned.
Thanks. We've had a question in for unquoted companies. How are the value of companies calculated for the purposes of business relief? Generally speaking, the net value of the company on the balance sheet is a good place to start. However, I will say that usually where we're dealing with any of these, we work very closely with our corporate finance team. They value businesses all the time, whether it's for sale or for inheritance tax purposes. So we would really look to speak to them and get proper valuations that can then be submitted to HMRC with all the relevant backup when looking at IHT planning. Again, if you want to follow up on any of that, do let us know. We can introduce you to our corporate finance team. And another question that came in, they seem to be mostly questions for me to answer, and hopefully I'll do a good job. Happy to follow up later. What impact is there on business relief or agricultural relief if a working farm leases some of its land to a solar panel development company? Interesting question. One actually we dealt with about 4 or 5 months ago. We had a client who had exactly this situation. I think the key term in there is leases. You're leasing the land, it becomes an investment activity rather than perhaps an agricultural or a business activity. You then have to look at the level of profit from that in comparison to the overall business. If it's fairly small in comparison to the overall business, you may still have business relief. But again, watch for that possible change from a 50-50 split there to an 80-20. So I think if that's something that you're considering, and there are other taxes as well that can be affected by that, then get in touch and we can provide some very bespoke advice to your particular business. So that is all of the questions that we've had in so far. If anyone does have any further questions, anything you'd like to ask us, then we'll put back up that last slide from Jonathan with our email addresses on. Do get in touch, and we're happy to follow up with anyone directly. So thanks very much for joining us.